Welcome to the Investing Markets and Money podcast, brought to you by the Armchair Trader. Earlier this summer, I went to a very interesting half-day investment symposium hosted by Marylebone Partners, and I thought it'd be very interesting to get their CEO, Dan Higgins, who is joining us today on the podcast, to talk a little bit more about Majedie Investments, which is their listed investment trust. So welcome to the podcast, Dan. Good to have you on.
Thank you for having me.
So to start with, can you give us a quick overview of, firstly, Marylebone Partners, and then secondly, the actual investment trust itself, Majedie Investments?
Marylebone Partners is an independent firm. We've been around for over a decade. We previously held senior roles at some leading firms like Fauchier Partners, Mercury Asset Management, the Wellcome Trust, Goldman Sachs. And our purpose, the reason we come into work every day, is that we want to make a real difference in the financial success of our clients. And alongside Majedie, those clients include charities and families and quite a lot of investment people. Our first clients many of them were investment people who've been very successful in their own right. And we think the best way of doing that is to use our network and our experience and our judgment to find truly differentiated fundamental investments. And then Majedie Investments is an investment trust. Its origins go back almost 100 years. It was the generational wealth creation vehicle for the Barlow family, an industrialist family, and it was listed on the stock exchange in the early 1980s. And although Majedie's style has evolved somewhat over time, there's really been a basic principle that's remained true throughout its life, and that is that by taking a very long-term approach and focusing primarily on equities, that's the best single way of compounding wealth after the potential effects of inflation over time. And our part in the Majedie journey, Marylebone's involvement with Majedie, really took place in November of 2022, when the board concluded that the investment landscape had changed somewhat and they wanted to find a new manager for this trust. And so we were appointed in November of 2022 and we took over management early last year.
Gotcha. And just to clarify for some people who are not familiar with investment trusts, the board of the trust is obviously independent of the board of Marylebone Partners. We do have a couple of other podcast episodes which go into much greater detail on this, but effectively what we're talking about here is the separate investment trust board deciding to appoint a different manager to run the investment trust.
That's right. So the investment trust is a publicly listed company, and the board has appointed us as the investment manager of the portfolio. And so as well as being ultimately accountable to shareholders, our kind of immediate reporting line is to the board. They hold us to account on an ongoing basis.
Now, you speak a lot about something called a liquid endowment approach when we're talking about Majedie. Can you explain a little bit more about what that involves as well? Because that's actually, even for me, that's a slightly new phrase.
Yes, so we coined this phrase "liquid endowment" to try to encapsulate what we do, and it does require a brief explanation. So I'm grateful to you for giving us the chance to do so. So let me elaborate. The endowment part alludes to the mentality and the investment philosophy that has served the investment programs of many of the elite university endowments so well over time. And essentially, that means to be very long term, very fundamental. So don't attempt to time markets or trade actively, to have a low or even no allocation to asset classes that have a low expected return, such as, for example, fixed income, and to have a much higher allocation to return seeking assets and sometimes alternative sources of return. So that's the endowment. part of liquid endowment, but as the name suggests, and unlike some of the very successful university endowments, we don't allocate to truly illiquid asset classes like private equity or venture capital or real estate or infrastructure. And that's partly because it's not our core competence. There are other people who do that very well, but it's also because in the investment trust format, there is a fair amount of skepticism in the marketplace about the pricing of deeply illiquid assets and also how well they might fare in a new investment regime that we can come on to talk about in a minute. So, in a nutshell, we seek to give Majedie's shareholders access to opportunities they couldn't find elsewhere, long-term, differentiated, fundamental investment opportunities, but without straying into deeply illiquid areas. So everything we do is independently priced by a third party, at least on a quarterly basis, and in most cases, much more frequently than that.
And what sort of, I mean, the trust itself has quite a blended approach, which is also quite interesting. You don't see that very often in the investment trust universe. Um, Part of the portfolio obviously invested with fund managers. What kind of fund managers then do fit the bill? Because you've mentioned very liquid assets off the table. So what sort of stuff do you like to invest with?
So a little bit over half of the Majedie portfolio is, as you say, allocated out to third party managers. But we don't think you will find any of these managers in the portfolios that are managed by our peers. And we only allocate to managers who we believe are world class practitioners in niche, structurally inefficient parts of the market where specialists tend to do very well at the expense of generalists or tourist investors, if you like. So we have an allocation to a manager based in New York called Paradigm Biocapital. And as the name suggests, they invest in transformative therapeutics. In our opinion, what sets them apart is this very unusual combination of financial acumen and scientific knowledge. And that's what enables them to capitalize on opportunities in a very exciting area whilst managing volatility and protecting on the downside. Another example, who you will have seen present at the symposium that you mentioned, is a fund based here in London called Helicon Investments. And the manager of that fund, called Federico Riggio, and his team seek out misunderstood special situations investments in really high quality businesses that are trading at low valuations because they don't conform to popular narratives or something is misunderstood by the market. So, in both those cases, they are equities managers. The underlying assets are fairly liquid, but they're very long term, they're very fundamental, and they're specialists. They have a particular style bias or a sector bias or a regional bias. And then, although most of what we do is in equities, we also have a meaningful allocation at present to specialist credit strategies. And that's because we believe that in a world of higher interest rates, where liquidity is a bit less abundant, leverage is harder to come by, and credit markets, corporate credit markets, are very bifurcated. It's a haves and have nots environment, that it is possible for the right managers with the right resources to generate, let's say, 8 to 12% returns with low risk that are pretty uncorrelated to other areas. So we have an allocation to a Boston based manager called Mill Street Capital, and they've delivered terrific returns with very low correlation through a combination of carry income on their bond portfolio and also price appreciation. And that particular group specializes in finding really off the beaten track high yield bonds that have fallen through the cracks of the credit markets, if you like. They've been overlooked or they've been jettisoned by rules based investors like collateralized loan obligations. And at this moment in time, the income on Mill Street's portfolio is in the low to mid teens with short duration, so without a lot of interest rate risk and with, in our opinion, low risk of capital loss. And something like that just wouldn't have been possible to find pre-COVID, and we think it's much more attractive than a generic allocation to corporate credit where spreads are quite tight again. So that just gives you a little bit of a flavour of the sorts of managers we allocate to. They're all very different, but the one thing they have in common is they're very fundamental. And I suppose the second thing they have in common is that they are all experts in a niche fundamental area that we think offers perennial opportunities to add value.
And it's fair to say that these managers are not the kind of funds that a retail investor can get access to, and it takes a lot of time and effort to locate this kind of investment talent.
Yes, I think you raise it's a kind of straightforward question to which the straightforward answer is yes. But I think I sense that behind it, there's a slightly more existential question, which is we're in an investment world where I think it is very hard for most investors to access really differentiated, compelling investment ideas. And if you'll indulge me for a moment, I think I think the origins of this go back really to the financial crisis, after which the regulator sought to protect retail investors by limiting them or the people who look after their wealth to daily dealing securities, UCITS funds, and so on. And whilst those investments certainly have their place, it is just not possible to access the sorts of opportunities that we invest in within those formats. It's not responsible to invest in high yield debt or a deep value activist situation if you're managing a fund that has daily dealing or weekly dealing. And over the 15 years or so since the financial crisis, as we all know, markets have generally gone up with a couple of meaningful hiccups. But the opportunity cost to most investors of being invested in ETFs or passive strategies rather than the sorts of things that I'm talking about has been very low. Retail investors didn't really need to access off the beaten track opportunities because the most obvious areas have done rather well. And the reason that uh, I wanted to mention all this is we think all that changed. We think it changed with COVID, and that in a new world, it's going to be absolutely essential to identify the best opportunities under the surface of markets. In a lot of ways, it reminds me of the sort of environment I grew up in, where I kind of cut my teeth as an investor. And to find those opportunities, you don't just need people and a process and investment capabilities, you need a network. And it's taken us 3 decades to build this network. It's not something that most retail investors can or would want to do. And the reason we're so excited about Majedie as a project is the investment trust format enables us to give those sorts of investments to investors, but in a responsible way.
Which is fantastic. It's absolutely great to be able to get access to that kind of diversified approach to specialist managers through a listed structure like an investment trust. You've mentioned already about how, I mean, they're not illiquid investments, but at the same time, they're not daily priced investments. Yet the investment trust itself is a daily priced investment. How do you manage, well, firstly, the liquidity risk that sets up, and then secondly, how do you manage overall risk in the Majedie fund?
On liquidity issue first, so the benefits or the appeal of the investment trust format is that it is closed ended, that there are not inflows and outflows every day, week, or month in the way there would be if one was running an open ended structure. So that does mean it is possible to invest in somewhat less liquid areas without running a mismatch, without being irresponsible. And as a firm, we have never been willing to run a mismatch between the things we invest in and the terms we offer our clients or investors. So we've genuinely, since our kind of day one back of the proverbial back of the napkin business plan, we've wanted to manage money within the investment trust format, and that thankfully became a reality in late 2022. Now that said, in our experience, the market is pretty good at pricing the illiquidity within the investment trust format. So what we've seen in the last couple of years is that the really illiquid investment trust portfolios have tended to trade at a big discount to NAV because, as I said a few moments ago, I think shareholders or the market generally is a bit skeptical about the pricing of some of those illiquid assets, and they know that if the managers of those portfolios had to raise capital to do a buyback or to buy something else that they thought was more attractive, they wouldn't always be able to do so. So we require a premium, require a higher expected return if we're going to invest in something slightly less liquid. And we just don't do stuff that is super liquid. So for us, the cutoff is really 2 to 3 years. I mean, the substantial majority of what we invest in, you could sell if you wanted to in a day, a week, or a quarter. But we think it's okay to have, let's say, 20% of the portfolio in things that are a bit less liquid, but they must be priced independently, and we must expect a higher return. You mentioned risk more broadly, and liquidity is an extremely important part of risk management. I think very often the convention is to treat risk and volatility as the same thing. And although they're certainly related, we don't think they're interchangeable. And I think it's one of the things that makes us a bit different. So to us, true risk is the likelihood of permanent capital loss. And volatility can contribute to that because it can induce mistakes. But there are many other things that contribute to the risk of capital loss that we also spend a lot of time thinking about. And we divide risk really into two types. The first are what we call internal risks. Those are risks that are specific to the investments that we make. Does a company have a sound balance sheet? Does a manager have a proper pricing policy in place? Does it have position limits? Could a special investment be derailed by a macro variable or something that's outside of our control? So those are internal and specific risks. And then there are also external risks, such as the risk the market goes down a lot, or a particular asset class does poorly, or an industry risk, or a geographic risk, common factors that might be held across investments that we own, and very importantly, their correlation to one another. And when we put a portfolio together, we go to great lengths to make sure that the underlying investments have very different return drivers. So to correlate, because we find differentiated idiosyncratic investments, the correlation of those investments to one another is normally very low. And diversification is the proverbial free lunch when you're putting together various investments that are uncorrelated to one another. But it is not a free lunch when you're investing in 20 or 30 things that all have the same risk characteristics. And so we spend a lot of time thinking about that. And for us, as well as illiquidity, I would say the other two really obvious risks to think about, or that we always bear in mind, are first of all currency. I think it's really underestimated risk, and our policy, at least, is to mitigate currency risk to a great extent by either investing in sterling denominated assets, or if we do invest in non-sterling denominated assets, because it's a really global approach, we will typically mitigate the currency risk using forwards to make sure it's a sterling portfolio. We don't feel we have any ability to predict the direction of currencies, and we never want that to be the major determinant in our success or otherwise. And then the other risk that tends to cause the permanent capital loss for those who use it irresponsibly is leverage, and we are leverage averse. So I think it was Charlie Munger, Warren Buffett's right hand, who said, "If you're smart, you don't need leverage, and if you're dumb, it can ruin you." And our belief is we can find lots of things that are capable of generating really attractive, fundamental, absolute returns, real returns, without using leverage. And finally, in my experience, the combination of the two, leverage and illiquidity, that's a toxic combination, and it's something that we avoid structurally.
And going, I mean, obviously, I keep dwelling on liquidity here, but actually, there is another part of the portfolio that is invested in companies as well. Um, can you give us a bit of flavour on what sort of companies the Majedie Trust invests in?
Yes, so just to contextualize all this, the 60-ish% of the portfolio is invested with external managers, as we discussed a minute ago. Around 20% of the portfolio today is in what we call direct investments. So, unlike a fund of funds, for example, we have an in house stock picking ability. And that has some softer benefits. So, we think we're much better at allocating to managers and at finding special investments because we ourselves are experienced equity investors. And by having 20% or so of the portfolio managed in house, we can reduce fees and we can improve liquidity. But the main reason we do it is that direct investments are a profit center in their own right. And we invest in good quality companies that have top line growth and strong business profitability and good balance sheets and good management teams. But our best investments we have found are ones where we can find a sheep in wolf's clothing. So a company that we think is really good quality, but the market thinks it has an issue of some description. So the one that immediately springs to mind is a US listed company called Wabtec. And Wabtec is a leader in the provision of services and infrastructure to the US rail industries. And when we looked at the company initially, it was very much seen as being the victim of a 10, 20-year cycle of cost cutting by the big rail companies. So as a supplier to those companies, they were really cramming Wabtec down on price. And where other people saw a problem, we saw potential because we realized that the big railroad companies were moving away from a cost cutting policy to greater investment in efficiency, in innovation, in digital solutions. And of course, rail is also a green form of transport. So there were various headwinds that we saw turning into tailwinds. And Wabtec at that time was much less expensively valued than a lot of the rail companies themselves. And fast forward 2 or 3 years, and Wabtec now has a $7 billion backlog. They've got $20 billion of visibility in the pipeline. Their margins have improved by 3.5-4%. Their operating margins in the last couple of years alone. Their cash generation is tremendous. So we think this is a really high quality company that was undervalued because the market saw it as a potential victim, and now it's a solution. And those are the ones that we really like, the ones that are not just good quality, but they're valued as if there's a problem.
And there's also a special investments category within the Majedie Trust. What goes into that specific segment?
Yeah, so that's the final piece of the jigsaw, if you like. 60% external managers, 20-ish% in direct investments, and then the other 20 is our target for what we call special investments. And I think this is probably the most differentiated part of what we do. So through our global ideas network that we've built up over the last 2 to 3 decades, we are given the opportunity a handful of times each year to invest alongside some of the leading investors in the world in their highest conviction ideas. And very often we can do that for zero or very low management fees, either because of our long term relationships with them or because they're already fully allocated to this particular idea. And so we can provide a bit of extra capacity. And we have 3 criteria for these special investments. The first is they must come from a trusted source. So we have a 1 degree of separation rule. If we know someone who knows someone, that's okay. But whoever brings an idea to us must have something to lose, either financially or reputationally, by bringing it to us, rather than just upside only. So trusted source is the first criterion. The second criterion is we are ambitious for these investments in terms of return potential. So as I mentioned a while back, if we're going to be willing to wait 2 or 3 years, we better be compensated with a higher expected return. So we must feel we can make at least 20% annualized returns out of these investments if we're going to commit. And the third is we must feel we can monetize them within 3 years or less. So nothing super illiquid. So maybe just to give you a couple of examples, because I think they really come to life when you talk about the individual situations. We invested in the public equity of a company called Shake Shack, which a activist investor called Engaged Capital, who's based on the west coast of the States, brought to us. And Shake Shack, as I'm sure many of your listeners will know, is a kind of upmarket burger joint format. It's a great format, has great customer volumes. It faces all the right demographics, and yet the stock had substantially underperformed its peers because the restaurant format itself had been managed by a celebrity New York restaurateur who was great at filling high-end Manhattan restaurants, but really didn't understand the basics of operating a quick service restaurant format. So Engaged Capital, the people who brought this idea to us, took a stake in the company, and they brought in cost consultants. They improved overheads. They implemented centralized buying of ingredients. They managed to get the property portfolio more effectively managed, and ultimately they were welcomed into the company by the founder, and it's completely transformed the profitability and economics of the business, and the stock prices performed very well as a consequence. Another special investment we made maybe 18 months ago was in the senior non-preferred bonds of Metro Bank, the UK challenger bank, and that was brought to us by a distressed debt manager based here in London called Caius Capital. And they identified that the bank was returning to profitability. Metro Bank has had a somewhat checkered history, but they were more profitable again, and that should mean they could buy back these bonds before the bonds lost their regulatory capital status. But the most important thing when we did our due diligence was that if that didn't happen, if things did not go to plan, the bonds that we're going to be buying in collaboration with this manager should be money good under nearly all scenarios. And it turns out that Caius had to earn their return the hard way. The bank was forced to recapitalize, had to raise new equity. There was an active restructuring over the course of the weekend, and the bonds that we had bought in the low 80s briefly traded as low as 50 cents in the dollar. And the reason I'm choosing to use this one as an example is that as of today, they're now trading in the mid to high 90s, and we've had a couple of very attractive coupons in the meantime. So it's a good example that volatility and risk are not the same thing. And another good example that if we partner with the right people who can drive, but not just identify these opportunities, but also drive outcomes, we are able to earn really attractive risk-adjusted returns for our investors in situations that I don't think would even get on most people's radar screens.
And it's actually incredibly difficult to do this, isn't it? Because you can see a company that looks good in many respects. I'm thinking particularly on something like Shake Shack, and yet the share price isn't where it should be, and it's a case of digging deep and working out what is going wrong. Why aren't the shares where they ought to be?
I think that's right. And I think you raise another existential question, which is we're having this conversation at a juncture in which markets more generally have been driven upwards by a very small number of stocks. Uh, it's widely known that kind of 7 to 10 large mega cap growth companies, primarily technology companies in the US, are responsible for the lion's share of the market move over the last couple of years, frankly. And whilst I don't want to get kind of drawn into the merits or otherwise of owning those particular stocks, we own none, by the way. Just on a look-through basis, we own only one of the 50 largest stocks in the MSCI ACWI index. And that just reflects the fact that there's a huge number of situations that have just been left behind in one of the narrowest market rallies in the last 50 to 75 years. And although markets themselves look fairly fully priced to us, there is no shortage of really attractive situations under the surface. Now, Shake Shack would certainly be one of those. We think we've got lots in our portfolio, but the question you raised, Stuart, is a really good one, which is like, who cares? How can we be confident that any of the names we own will get the market's attention? And one of the ways is that we partner with a group who draws attention to the anomaly and has levers that they can pull or actions they can make to realize value for shareholders. And it does work. It doesn't. It sometimes takes time and patience, but it does work. And one of the things we're really excited about at this moment in time is there's no shortage of opportunity, and we know people who can help realize the value or monetize the value. Because there are moments when I think you have to question whether markets are truly functioning as an effective discounting mechanism. And I think you either need to be invested in things that are so cheap that the cash flows are coming back to you as a shareholder over a very short period of time, or when you're in a situation that there is an identifiable catalyst or a change in narrative that might mean the market cares again.
And something else I wanted to ask you about was you started managing the Majedie Trust in 2022. Now, obviously, when you took over that trust did not immediately reflect your investment strategy, so it's taken time to actually transition that. But obviously, the discount on the fund is narrowing, so you're doing the right things. Can you just explain a little bit about how you move something like that once you take it over to where you are now, and how close do you think you are now in properly reflecting the strategy as you want it to be?
So the last bit is really quick and easy for me to answer, which it's 100% where we want it today. And we moved fairly swiftly. I mean, the portfolio we inherited was very liquid. And so there were no legacy assets or toxic assets that we had to dispose of or liquidate. We were able to sensitively but swiftly make the portfolio our portfolio within a matter of weeks, if not maybe took a couple of months, with the one exception being the special investments. And by definition, they are opportunity driven. The bar for inclusion is extremely high. We turn down 7 or 8 opportunities for every one that we invest in, and we're only looking at things that we think are potentially interesting. So that's taken, to be candid, that's taken a bit more time than I would have anticipated, because our bar for inclusion was very high and because some of them worked sooner than we thought, so the cash came back to us quicker. So it was a high class problem, but it took us time nonetheless. So we're now up to, our target for special investments, or our immediate target was to get to 20. We're in the mid to high teens today in terms of overall allocation. And so the portfolio is very close to how we envisaged it would look. It took us a bit longer to get there, but we genuinely wouldn't change. We wouldn't change a thing today. It's exactly where we wanted to be. With respect to the business strategy, which I think is what drives the discount, ultimately, in my experience, I think what narrows a discount to NAV is the expectation of future returns and scarcity and differentiation. So the investment trust market, I think, is pretty good at working out whether they could or could not get the same underlying proposition elsewhere in a different format. And that's frankly why the board, I believe, appointed us as the managers, that they felt we could bring something really different to the sector that just didn't exist at present. And so when we were announced as the new manager of Majedie, the shares were trading at pretty close, nearly a high 20s% discount to NAV. and they've come in meaningfully, thankfully, over the 18 months or so that we've been managing the portfolio, but they're still at a discount. Now, over the same period, your listeners will know that the sector has gone from a small discount to a very wide discount. So we've slightly managed to resist the general trend, but we are incentivized on the share price, not on the NAV. Our fee is taken on the share price. And so we are aligned. Our interests are the same as other shareholders. By the way, we are investors in Majedie ourselves. My old boss always used to tell me he would never get on a plane unless he saw the pilot was sitting up front. And we would neither invest in a fund where the manager's own capital was not at risk alongside our clients, and our shareholders should expect exactly the same of us. And so our job is to do a good job of investing above all else, but also get the message out to retail shareholders, wealth managers, institutions. The largest single non-family shareholder of Majedie today is an Oxford college, which I think again lends real credence to the liquid endowment mantra. And we want to bring new shareholders on board, and we'll continue to get the message out there in a sensible, measured, constructive way. And ultimately, I really don't see any reason why Majedie shares could not trade at NAV again. And short term, that reflects market conditions, but long term, it reflects the things that I've just been talking about.
So basically, very quickly before we let you go, elevator pitch. Why is it the right time now for investors to be looking at an investment of this nature?
Three things I would say. The first is the shares are at a discount to NAV. So I think it is an asymmetric proposition, if nothing else, and it's a real NAV that you can believe in. The second reason is the portfolio is hugely differentiated. It has lots of return potential and catalysts ahead, and that is at a time when markets have had a good run, but are deeply lopsided and concentrated in a few stocks that may or may not be able to hold their valuation multiples. So we think the portfolio is attractive on an absolute basis and also relative to other options. And finally, we believe markets are now in a new regime. There will be cycles around interest rates, but nominal interest rates will be higher than they were pre-COVID. There will be less leverage. There will be more variable liquidity conditions. And all of that will mean there's going to be more dispersion under the surface of markets. There will be bigger differences between the price moves of winners and losers within every asset class, region, industry. And we think the days in which a generic exposure to markets is going to deliver really attractive inflation-beating returns have therefore gone, and it's going to be critical to find compelling, differentiated bottom-up investments, and that's what we do. And Majedie's full of those ideas.
Fantastic. Well, thank you very much indeed for your time today, and coming on the podcast, Dan.
Pleasure. Thank you for having me.
So you've been listening to the Investing Markets and Money podcast with me, Stuart Fieldhouse, and we've had Dan Higgins, CEO of Marylebone Partners, on this afternoon. You've been listening to the Armchair Trader podcast. Make sure you visit our website, www.thearmchairtrader.com, for your daily dose of financial markets news and sign up to our free newsletter there.